Awesome. Cool. Let's go ahead and pound it out. So we're going to talk about crypto correlation. Now, it seems like almost half the room, which is incredibly surprising, knows who this man here is, which is awesome. He's like so cool. Biggest hedge fund manager on the planet. Is really cool. And we're going to talk a lot about some of his work very early on here because correlation is the key to all of the investing that you do in all of crypto, assuming you're kind of taking that investing and then letting the money grow kind of perspective. Now here we have kind of Bitcoin. Anyone ever heard of like Bitcoin related to gold? Or like Bitcoin is the new gold? Okay, it's kind of like a popular narrative. You heard of it? It's the narrative a lot of people go by. And Ethereum, similar, kind of in the technology space. You got all these Wall Street guys analyzing how's everything going to do. And that was a really popular message for a very, very long time. That was a very popular investing message for cryptocurrencies, for crypto assets. It's this hedge against inflation, this hedge against the government, this hedge against all the printing. You print all the money, but there's only so many Bitcoins, so many Ethereum, Ether, yada yada. That was a really big memo for Bitcoin for a very, very long time. And then it kind of all stops, kind of all came crashing down. But before it did, this is when Bitcoin was at about 5,000. This news article came out, and they published this incredibly interesting image that I think the world is so happy it has been graced with. And it's just Bitcoin in this gold vault. And that was a message a lot of people stood by until the beginning of this year, the beginning of last year, and mostly in this year, when Bitcoin really just kind of diverged from a lot of the indices or a lot of the commodities it was theoretically close to. So you see here we got oil, yellow, and gold and yellow, oil and black, and then Bitcoin just really doesn't correlate with them very much. And the reason why is a lot of times when markets go down, when investors panic, funds move into commodities, funds move into gold. It's a pretty normal thing. In 08, markets started crashing, gold went up about 250%, 2.5x, about 140%. It's like a pretty common memo, and people think, oh, well, if these gold commodities do it, then Bitcoin should do it. But as we've seen recently, crypto is kind of emerging as its own asset space that isn't particularly correlated with any of these more traditional financial investments. And perhaps of significant importance to really look at here is that the market tanked. I mean, was anyone here trading in the markets in kind of February, March 2020? Yes, couple people? Trade the stock market, any markets, yeah. I mean, so when there was that huge crash, Bitcoin followed suit. It had some of its worst days in many, many, many years. It was just really just plummeted off like most assets did at the time. It was very close to most of the other assets. And for a lot of people, that was the start of, hey, this is no longer our reality. We're entering maybe an asset that is its own class and its own investment. And that is really, really important when you start to look at building up your own portfolio. Now, show of hands, who's ever seen kind of a pie chart like this? Maybe you think of like some investment manager at a bank pulls up a pie chart and he's, yeah, a little bit. He says, oh, you need to allocate your portfolio. So yeah, a little bit, right? It's a pretty standard idea. It's a pretty normal kind of thing, just diversification of your investments. And there's a lot of really kind of in-depth strategies we could talk about there. The basis of it is very simple. Say we have an umbrella company and say we have a sunscreen company. When it's summertime, a lot of sunscreen, maybe not so much umbrellas, and even just intermittently throughout the year, the umbrella company does really, really well, the sunscreen company does really, really poorly, and then vice versa. So if you invest half and half in each, you're going along for a lot smoother ride than if you only invest in the umbrella company. Now in this fake example, you'll also notice that if you only invest in the umbrella company, you get to a similar mean, similar end, assuming they have the same return. And so really what that diversification does, what in an ideal, perfect world, what portfolio diversification like this does, is it just mitigates volatility. And that's really important because most funds and most investment managers and most of the positions you enter into should be judged largely on volatility. The less volatility you have, has anyone here ever heard of like bonds or treasury bonds or CDs, stuff like that? It's very common, low risk, you're basically guaranteed a return. And so the returns are really low. Ideally, you want to have really high returns with really low risk, really low volatility. It's pretty common, pretty standard stuff. And so when you think about crypto, it's really important to understand that it isn't as correlated as most people think to most other financial products. And in reality, as we've kind of seen emerge in the past year, it is a very uncorrelated asset class from all other financial products, investments you can make. And so this is where Ray Dalio comes in. This is a culmination of decades of Ray Dalio's work, and he calls it the Holy Grail. It looks kind of mathy, but it's actually like so freaking cool. And the idea is that when you increase your number of assets while decreasing their correlation, you start here at high correlation and you go here to 0% correlation. The lower the correlation between all those different assets in your portfolio, the lower your chance of ever losing money in a given year. So you have your whole portfolio in Bitcoin. Anyone ever had in like a very, very large part of their portfolio in like one investment? A little bit, yeah. What industry was it in?
Crypto.
In crypto, okay.
When you diversify, I feel like I should have like just a few companies and try to get like outsized returns, but I always like
have a few companies. Well, that's a good, if you can pick really, really good companies and you can weather the volatility, it's a solid strategy. Challenges a lot of times. It's like, what do you do? But 100% picking really good companies is like the way. This is kind of, because the more you're involved in your investing, the more you can do that, the more control you have over what it is you invest in. And that's when you get into trading, this is completely irrelevant, right? When you're just trading on technicals, you're trading just specific assets in short-term trades, or maybe just like you said, you know more about the company, you know more about the trade, then that's kind of a case where you can really start to verge away from this and have more correlated assets. Usually I kind of cap those positions at 7% portfolio exposure. That has worked really, really well for us. But in general, when you're just investing maybe in broad markets, when you have lower correlation, you can really smooth out your portfolio, because we all like to say, oh, I would hold Apple stock if it happened tomorrow, and I would believe in the company long term. But when the time comes, that proves pretty challenging for most investors. This idea of selling low and buying high is it happens because a lot of people make investments, like we talked about 2 weeks ago, based on emotion, and that emotion can play in, especially if your portfolio, maybe you have an unexpected house payment, something goes wrong, you need cash. And so a lot of times mitigating that risk and volatility is like really, really cool. So that's where we kind of have this holy grail of investing, where you lower the correlation and your assets in the portfolio, and voila, you have a lot more consistent growth. And so that's the cool thing about crypto, is that it can make up a very cool little niche part of your portfolio, where it's just a really, really solid uncorrelated investment space. So you can allocate a pretty sizable amount to it, versus traditionally, this is just something I found. You have a mid-cap fund, a large-cap fund, a small-cap fund. Those are all extremely correlated. If the stock market goes down for large-cap companies, it usually goes down for small. It's very correlated. So this would be a really poor diversification strategy. Bonds, similarly, will follow this very similar trend with most investments. And so the crypto and other kind of assets really form a very strong piece of your investment portfolio, because they offer those returns without that correlation.
I would say that bonds are extremely correlated with
the default rates, yeah. So when the market goes down, when the economy crashes, you'll have like a lot of those bonds will default. And if you look at the funds, are you familiar with bond funds?
Yeah.
So usually the bond funds will stay at like 100% par, but when markets are crashing, everyone's all emotional, everyone's all selling and trying to get out, the bond funds will trade below par, so they'll lose market value, and a lot of times they'll have losses on the portfolio because of defaults. But the bonds, if you just look at bond funds, they're not, stock market goes down 40% in 08. The bond funds will go down 7, 10%. It's not as big of a loss, but they're still extremely correlated. And there's a lot of really cool research on bonds and bond funds, and they tend to do very, very similar, at least in the US, to the equities market.
Well, so what I've heard, and I haven't researched it too much, but I've heard that they're inversely correlated, because when markets go down, interest rates go down generally, and because of that, the value of current bonds go up.
Yeah, that's a really good point, and that's definitely usually true in sort of the longer bull runs. But when you get to the nitty-gritty of it, and that's the same thing. So when the market goes down, bonds go down less. When the market goes up, bonds go up more, 100%.
Well, no. I'm saying the opposite. When the market goes down, bonds go up. because interest rates drop,
Ah,
right? Current market interest rates drop, and you're holding this bond that has a premium interest rate, and so you're able to sell it at a premium.
yeah, for the individual bonds.
Yeah.
Yeah, so you're saying when the market goes down, the interest rates drop, and then the individual bonds go up in value.
Yeah.
That's true for individual bonds, and
shouldn't that be reflected in a bond ETF?
So it's not reflected in big portfolios of bonds for two reasons. The first is just the market emotion. Most of these are traded as ETFs, so they aren't, they're not actually at par. They can trade below their par value. They can trade below the book value. But more importantly, it's just the default rates. In most cases where you have like actually defined, like the '08 crash, the dot-com bubble, when you have very systemic crashes in the market, usually that it very commonly leads to higher default rates. Tons and tons of companies went bankrupt with these financial crises, and that hurts the bond fund portfolios significantly. And there's a lot of really cool research on there. Vanguard has some really great research on that, and you can do pretty simple comparisons of bond funds versus equities, and you can see it's pretty correlated. Okay, cool. So now we get to what we were talking about earlier, the idea that crypto itself might not be correlated with other asset classes, but most of crypto is really, really correlated. So if anyone has ever invested in crypto, I think you kind of get the idea here, is that if Bitcoin goes down, if Ethereum goes down, basically most other cryptos are going to go down as well in a given 24-hour period, 1-day period, something like that. And that's really important because most people will invest in different sectors of stocks, and you get pretty good amount of diversification with that in the equity side. But when it comes to crypto, investing across the market is it's kind of trivial. Investing in projects versus companies versus really the bigger more index-like funds, more index-like cryptos, it effectively yields the same correlation. You have really just very similar. Everything kind of moves in the same general direction. And so here's kind of showing this. Usually you'll have a chart like this, and it'll say the core, and I know it's a lot of numbers, and looking at a lot of numbers, forgive me, I will explain it then. So you have basically a set of currencies, a set of cryptos, and another set it's the same set of cryptos, and you're just looking at the correlation between one another. So here you can see when you compare them to each other, they're always correlated the same, right? You compare Steam to Steam, it's always going to be 1. But what you're really looking at here is the entire rest of the chart. So when you look at Steam versus Ethereum, it's a smaller number, about 0.04 here, and that means there's not much correlation, right? Versus when there would be more correlation, you have Ethereum Classic versus GNT, about 0.63. So closer to 1, the correlation coefficient, pretty kind of basic statistics kind of thing. We're all kind of familiar with correlation. Okay. So yeah, closer to 1, it's really correlated. Green means really correlated, and then negative would be inversely correlated. It's like opposite. What you see with most of these crypto assets is they're extremely correlated. Usually with a chart like this, if you're looking at equities or any kind of investments, there is some variation. It's not entirely green. There's usually specks. There's a lot of red, and that's going to come primarily down to the beta of most cryptocurrencies. And all beta is just the correlation between the asset, whatever the coin is, with the underlying market. And for all intents and purposes, we can kind of call Bitcoin, maybe a weight of Bitcoin and some of the other top ones, as the market.
So why does it say Bitcoin and Ethereum are inversely related? Even though like you see a graph, like they kind of move in tandem.
Yeah, that's facts. I didn't make this. I didn't do this correlation. I don't know what the study period is for this. It might be a weird study period. That's like 100% facts though.
Yeah.
I didn't make this. But I think so a lot of times it will come down. So when I was trading kind of Bitcoin at its peak, it was really interesting because Bitcoin would go down and Ethereum would go up, and they were inversely correlated in some shorter time frames. And it messed up a lot of our trades. I was really sad about that. And so a lot of times it comes down to the time frame. But when you look at the long time frame, most of these are really correlated. And it looks like that it might have done something weird on the edge cases. So the beta of the whole market, everything is fairly correlated. And the alpha is really what makes these not all close to 1. Because in reality, from experience, these are all pretty close to 1. And if anyone's ever, you kind of trade crypto or trade across currencies, you kind of get the feel very, very quickly that everything is very highly correlated. And so you'll see a lot of these are smaller, and this actually is likely, if they went really far back, Ethereum's all-time total return is like 10,000% more than Bitcoin if you go from like the ICO, the initial offering they had. And so a lot of times these are really correlated at the base, at the beta, just at the correlation of the market. And then when you see numbers that are smaller or even negative, a lot of times that comes down to alpha. So alpha is going to be the return in excess of the market. So if we call the market Bitcoin, Bitcoin goes up 15% and Ethereum goes up 25%. That alpha is going to kind of hurt that correlation coefficient. It's going to get a little bit less correlated, not because they didn't have a very similar movement on the underlying beta, but because the asset itself just moved different than the market and it had an excess return. That's usually why you see numbers here a little bit smaller. But in general, the important thing to take away from here is that most of the coins are very correlated. And so when you make a portfolio and you're just going to invest in it and kind of let it be, it doesn't make very much sense to just kind of spread it out all over the place. We tried that for a while at the fund. It just didn't make particularly much sense. Instead, what makes a lot more sense, we talked about a couple weeks ago, is to just execute your research and really research into these projects and figure out which ones are really great projects and kind of look at where most people are placing their money and kind of understand what those projects are. And as you mentioned, find the ones that are going to out-return the market. And then when you do that research, when you do that fundamental work, you can really secure a lot of that alpha. And then, bam, you have a much better returning portfolio that's still very highly correlated. You know, your portfolio, no matter how many altcoins you buy, which are just smaller cryptocurrencies, is probably not going to go up when Bitcoin loses half its value. It's not going to happen. But over the long term, you can really increase your returns when the market is doing really well. But of course, just remember that that's generally also going to make your losses a lot faster when the market's doing poorly, just because pretty much everything's going to be more volatile. Like when we talked about investing emotion, ETFs, and kind of Bitcoin filling this role as a market indicator, market ETF. Most of these other are more sort of the individual stock kind of volatility. And so because of that, they have a much, much, much higher, this is just an example, there are thousands of charts just like this, without a doubt. You have a much higher ability to create really great returns. This went, Stellar went from effectively like nil fractions of a penny to 80 cents very, very quickly, and subsequently has had some really, but then it also lost all of its value, right? So Bitcoin lost half of its value in this time period that it took for this project, it was like almost 80% of its value. And so you want to understand that when you veer away from sort of the main, bigger players in the game, and you get closer to sort of, we'll get to it later, more of those individual companies when we talked about emotion, you have the opportunity for a lot of really great returns. And I was in Stellar kind of right about here, based on technical analysis and based on research. And that research really is going to open up these opportunities where you learn, because a lot of times the first hurdle is just learning about what these assets are, learning what these cryptocurrencies are. And that just comes down to really researching it. And then you really have a lot of great, when you execute it right, you time it right, a lot of great opportunities. There's just a lot of really new assets that fundamentally maybe people don't understand, people haven't heard of them, and that leads to a lot of opportunity where you can pick individual positions that do really, really well because you have found that alpha, and it'll really, I mean, we can talk about correlation here all day, and I almost feel academic talking about it because I remember when I started trading, I never cared even a smidge about correlation. I was like, I'm going to buy this stock and I'm going to sell it, and I'm going to buy this stock and I'm going to sell it. But when you look at really constructing that overall portfolio and you want to just kind of walk away from it a little bit, that correlation has a really big impact on sort of the work you have to do in your portfolio. You can work a lot less when you have less correlated assets and you have less risk in your portfolio. You can kind of walk away from it and not worry about it too much. And that gives you a lot of clarity. So you can make an investment and then wait 5 years and see how it comes to fruition because you don't have all that volatility. So with that said, now we're going to move on to really looking at the projects you're investing in, the companies you're investing in, and how to look at them. So has anyone of you ever formed a company before? Really? What state?
Illinois.
Illinois. Ah, that's so cool. I got candy in the bag over there. You can answer so many questions, Judy. 100%.
About an hour outside of Chicago.
You know Peoria?
Yeah.
I used to live there, but I moved to Metro Atlanta 5 years ago.
Oh, that's cool. So in Illinois, is it similar to this? Just one piece of paper, or is it two pieces of paper?
I think it's 2.
It's 2 pieces. Was that for LLC?
It was an LLC.
LLC. Okay, yeah. LLC's usually 2. Yeah. So a piece of paper, guys. Sorry, a company. A company is just a piece of paper. All right. Just this is a filing cabinet. As Paul just said, he formed a company as 2 pieces of paper. All you do is you fill out 2 pieces of paper. You kind of write down your address and how many shares of stock. It depends on the kind of company. It's literally just 2 pieces of paper. You pay the Secretary of State $200, and you just mail it to them. And bam, you're like that is every single company. So when you think of companies, think of all these really, really big institutions, these really big firms. At their core, what makes a company is very often just 2 pieces of paper, 1 piece of paper. Abroad, it's a couple more pieces of paper. It's just it's just paperwork, right? That's all a company is. All a company is at its core, at its foundation, is just paperwork. And so the question becomes, well, why would you make a company? Why would you form a company?
Liability.
Yes, sir. Liability is a big one, so you don't want to be liable for the company's debts. Another really important one is money, right? You want to keep most of your money. And pretty much everywhere in the world, when you're an individual and you make money, the way it works is you get your money in, and then you pay taxes on it, and then you can spend whatever's left, right? Companies are really cool because when you fill out this piece of paper and you make your company, all of a sudden, and there's different ways you can go about it, there's different structures, yada yada. All of a sudden though, and when you form your company, you can take money in and then spend the money and then just pay taxes on whatever's left. And there's a lot of really great books about how to make sure that there's nothing left by making like actual legal investments. There's like a lot of I spent months in the tail end of high school doing nothing but reading thousands of pages of tax law. It's like really, really cool because once you understand it and you have a company, all of a sudden, instead of paying a bunch of taxes and then working with the money that's left over, you take in all your money and then you just spend it on whatever you want to do, and then you just get taxed on the rest. And a lot of times you can invest in research, right? Amazon pays a very, very, very small amount of taxes because they spent years and years and years and years on booking up research costs, and voila, it goes in on your company's tax report, and look at that, you're not paying taxes. It's like the coolest thing. Robert Kiyosaki, he has a lot of really, really great books on this kind of information, and if you want to learn more about like the specific strategies, there's a lot of really great resources out there. And the cool thing is all those resources are based on the tax codes in the US or kind of wherever you are, and so it's all public, it's all out there. It's just like going through the source code for Bitcoin, going through the tax documents for wherever you are.
So how can they have like very different numbers for like their tax filings versus their SEC filings?
So they're the same, right? Yeah, the tax filings are just the financials of the company, and then for public companies, the SEC reports are just the financials for the company.
So how can a company like Apple make like $50 billion in profit but like not pay taxes on that? Tax credits and stuff?
Yeah, so how could Apple make billions and billions and billions and not pay taxes on it? We could talk all day. There's a lot of really cool strategies. I don't want to say I'm like giving like legal advice, but if you rent a plane and you go on this vacation to Hawaii, as long as on your vacation in Hawaii you spend, I think it's last I checked, it was 4 hours doing some kind of business meeting, some kind of business activity that you have to be in Hawaii for. You have to take a really important phone call in Hawaii. I'm not like a lawyer, but last I checked, and you can write off a 2-week Hawaii trip, all the planes, the airfare, you can do like 50% deductions on the meals if they're business meals. You just qualify everything as business expense, and there are some nuances to it for sure. One thing Apple, but all of that so you have your income, and you can deduct all of that from your income and just pay taxes on what's left because it's just you count it as an operating expense for the business. Apple does some really clever things. I think they have in Ireland, from what I remember, they have companies in Ireland that own the patents from the engineer. Yes, and so in Ireland and some of these other countries, there is like no tax rate, right? Yeah. So if Apple pays $100 million for licensing their patents to Apple Ireland, all of a sudden you subtract that from how much money they make. They don't pay taxes on that anymore, and now it goes on to the Apple Ireland books, and Apple Ireland makes $100 million, and then there's a lot of ways you can do it, but in Ireland you can do a lot of really cool things with that, where you're like, okay, cool, this is our money now. It's when you get really big, it kind of becomes a little more complicated because it's shareholder money, and there's you got to abide by SEC rules and all that. When you have your own private company, when you have a little small company, or even just like medium, large size companies, a lot of times you can do some really cool things where you very legally just expense parts, anything you would do for your business from the business's income, and you can do some really, really cool things where you basically just don't pay taxes on money that you're spending for the business or money you're investing for the business. When you get into real estate, which I know like almost nothing about, but you can do some really, really, really cool things with real estate where you kind of invest the income in. I don't know too much about it, but you just
one of the things is like a depreciation deduction.
Oh my gosh! Depreciation is awesome. You can pay like $100,000 for some whatever business, whatever, and then you can depreciate it over the years. And say you depreciate $50,000, you can do a cool thing nowadays where you just depreciate the entire purchase price in the first year, which is like awesome. But it's another clever way to mark down income to make it lower. And the cool thing is, if you fully depreciate it in the first year, you still get to use it. So say you buy like a new car or a crane or something for the business, you can write all that off with depreciation, but you still have it, right? So it looks like you've lost all that money and it's all gone, but you still have the asset. And those are all kind of legal tax incentives that businesses have to invest in properties and invest in businesses, buy things, etc. You do like interest expenses, yada yada, a lot of really cool things.
They allow you to do that? Just like write it all off in the first year? I never heard it. I thought they were like really strict about you following like a depreciation schedule.
I think there's the section 109, 179 deduction where you can do like 1.4. Last I checked, it was 1. Last I did my taxes, which it was about $1.44 million a year you can do under that on a 179 or a 109 claim. It depends on the laws change, yada yada. That was introduced fairly recently. Well, it was like 8 years ago from what I remember off the top of my head. And then even if you do accelerated depreciation, there's a lot of like. I'm not a tax attorney, but there are a lot of really cool things you can do with that. So as we start to look at crypto companies and just crypto in general, this is a pretty famous shirt. Vitalik, Ethereum guy, printed it after they made the ERC-20 standard, and his joke was that it was so easy to make an Ethereum token, you could do it on the back of a t-shirt. And it's like 20 lines of code, and bam, you have an Ethereum token. Just like when you file that piece of paper with the Secretary of State, you fill out your name and your address and a little bit of other info, and it's like, bam, you have a company. It's like there's a very low barrier to entry. Anybody can form a company, anybody can create some Ethereum token today. Like you just create it, and it's like, bam, I have an Ethereum token, and and that's it. It's a very low barrier to entry, and that's why, like talked about last 2 weeks ago. You have a lot of projects just because the barrier to entry is so low, and that's why research is really important. When you do invest in these projects, you really want to understand, hey, is this somebody that filled out 3 pieces of paper and just, because a lot of projects, at least really bad ones, they'll literally just use default ERC-20 contract codes, and bam, that's our project we're doing, and then they'll just advertise it and market it. You'll see with a lot of the more questionable ICOs, most of their money goes into marketing, almost none of it goes into development. ERC-20, I'm sorry. I remember because I'm like, this is basic knowledge. And then I remember I was talking to the CEO of, like, literally, I would say, the largest blockchain mining company in the United States. And I'm like, are you familiar with what ERC-20 is? And he didn't know what it was. And so it was really bad. So are we kind of familiar with ERC-20? It's just a standard. So with Ethereum, are we kind of familiar with smart contracts? Okay, so smart contracts, you can just write the contract and put it on the blockchain, and voila, it'll execute. It'll do whatever you tell it to do. ERC20 is just nomenclature for a standard open source, kind of like a GitHub repo. So you have a GitHub repo for Ethereum, you have a GitHub repo for Bitcoin, for all these projects. It's just a standard kind of template. You know, when you were a kid and you kind of got like that MLA template off of the first results on Google, and you got that template for whatever project you're doing. It's just like that. It's just a basic template that you have in for recording value for having your own token. So you can say you get 100 Paul coins, or you send 100 Paul coins, you know, whatever. It's just a very basic template for having your own crypto token. And it'll let you do all those things that we saw on week 2, where you sign the transaction and then you send whatever the currency is. So you can just generate kind of arbitrary tokens, whatever. And then for most initial coin offerings, I'm kind of familiar with initial coin offerings, like kind of basic, broad. Okay, cool. So people will send cryptocurrencies to your basic contract, and there's a little more code involved there, but it's very basic. It's pretty open source. Everyone kind of is familiar with it. You send money to the contract and you receive whatever the ICO token is. And that's what ICOs are. ICOs are kind of the first phase of investment when you get into crypto. And they used to be a lot bigger. They were a lot bigger in kind of the 2017s. And most of those ICOs were just very simple contracts like this. And there are just a very surprisingly large number, like multiple dozens of ICOs where they had literally this, or something extremely similar to this, or just ERC20, just the basic template copy-paste contract code, and like a 5-page white paper, and they would raise dozens and dozens of millions of dollars. And so that's kind of where we get into the next really, really important fundamental concept to understand. If you're looking at ICOs, and you'll see them, you'll see a lot of them just across the market, and you'll even see them with bigger projects. Ripple is going through a huge lawsuit with the SEC as of late, and there are a lot of other companies that are in very similar situations, because if you sell, securities. I have shares of my company, I sell them, they're securities. I have pieces of paper that say you'll get a profit from my pickle farm, and I sell it to the public. That's a security, okay? And there's, just high level, most investments are securities. When you sell things to other people, it's part of your company, or you promise a return, or it all resembles some kind of investment. That's a security, okay? Most of the tokens where most of the initial coin offering very blatantly are securities offerings, where you're selling securities, you're selling, hey, this is our project, this is what we're going to work on, and we want you to buy into it. Give us your money for it. That's a security. When you issue tokens, they're basically securities. And there's only a couple of headline lawsuits based around these assets as securities. But at the end of the day, most of the cryptos out there are securities through security offerings. Ethereum was a security, and the SEC was just kind of like, we're not going to deal with this. We'll just ignore it. Most of these assets, and especially with ICOs, you'll see companies, they'll raise $20 million and they'll sell, like Binance did this, they sold a bunch of Binance tokens in exchange for initial capital. That is a securities offering. Friends of lawyers working on the Ripple case, and he says, tell all the crypto companies to raise all their money and then set aside a third of it for me, because they're going to have to pay all those legal fees with the SEC, because it's a nightmare. When you sell securities, you have to go through an incredibly large amount of disclosures. Back in 1929, when there was the Great Depression, a lot of that came from just scams where people would sell securities that were unregistered. There was a lot of manipulation in securities, there's a lot of manipulation in bookkeeping. And so there are a lot of disclosures you have to make whenever any American ever can buy any of your securities. That's why the Securities and Exchange Commission exists. That's like basically their whole job. And most of these assets are securities. So you're going to see, you just have to understand that, first of all, you have to pay your taxes on these investments. And most of the time, the exchanges out there aren't going to do the heavy lifting for you. They're not going to give you, anyone here ever opened like a brokerage account? And then at the end of the year, you get a dividend form, or you get a stock sale form. It tells you all the money you made. Good.
1099 miss? I think it's 1099 miscellaneous.
1099 mist, 1099 div, 1099 the broker one, yeah, 1099B, yeah, the 1099s. Most crypto platforms, including Coinbase, as of late, will not give you these documents. Well, they might do, but they didn't do it. Okay, the other year. So, yeah, they changed some of the things they did once they went public. These platforms aren't going to keep track of how much money you make, and it's really important that you account for them because you don't want to be in a case with the SEC. You don't want to be in a case with the IRS over misrepresenting how much money you make in your securities investments. It's just a nightmare to go through, and it's just a lie and bad stuff.
I think it's also valuable to say that a lot of times those exchanges can't, because you deposited crypto, and so there's no way to establish cost basis unless you manually enter that.
Yeah, it's
theoretically they could if you buy and sell on their platform only, but I think most don't even in that situation. But a lot of times they just can't.
Yeah. So we Paul mentioned is that most crypto exchanges don't even have your cost basis. They don't know, because on the blockchain you can just transfer peer to peer, and like who knows, right? And for a lot of these exchanges, some of them don't even take your credentials. At least for a while, you could just sign up for an account and deposit Bitcoin and sell to dollars and withdraw. It was kind of nutty for a while, and that led to a lot of tax fraud, a lot of tax. If nobody knows about it, I don't have to report it. Like, that's illegal, right? And then a lot of times they don't know the cost basis. Yeah, you have to self-report the cost basis. What we saw, at least in the futures market, there were a lot of crypto exchanges and platforms that were trading futures products, leveraged cryptocurrency contracts, stuff like that. And it was seen more so in this space than with the crypto broker space. And if anyone's ever really gotten into the nitty-gritty of crypto exchanges, if you go on Coinbase and you go to any asset, you click markets, you can see all the exchanges that trade the coin. You'll notice that a lot of them don't allow U.S. residents, and that's purely because of this right here. In the futures market, with those exchanges that were trading futures products, they especially do not allow U.S. Citizens to trade most of their products. Most of them don't allow U.S. citizens to register, because that goes through the Commodities Futures Trading Commission, or if you're just the coins themselves go through the Securities and Exchange Commission, because most of them are securities. If you have any U.S. resident trade that, there is just a nightmare of legal hassle you need to go through as a platform, as a broker, as an exchange. There's all this regulation you have to go through to be like a stock exchange, right? If you wanted to be a stockbroker, if you wanted to be a stock exchange, there is an incredibly large amount of regulation you have to go through to do that. And most of the crypto exchanges out there are regulated, at least a lot of them have like very, very little regulation. Most of them are registered in the Marshall Islands, which has no financial law, effectively no financial laws. And like 80% of them are registered in the Marshall Islands because they have no financial laws. I can talk all day. This is not the point. We can talk more after class. A lot of times there aren't securities laws in these countries, and you can just get away with a lot of crazy stuff. So with that said, just understand that's a risk factor in most of the smaller investments you make when you look at ICOs. So here's an example of an ICO. These guys raised $75 million in 2017, tail end of 2017. And then basically the founders disappeared, everybody disappeared, the wallets sold all the money, and poof, everything disappeared. Nobody knew anything about the founders. There was almost no information on the project. And it's basically they just stole $75 million. And there's more to it, but that's high level. So a lot of these very, very, very early stage investment opportunities, you really got to be careful and understand what you're getting into, because the barrier to creating most of these assets is very, very, very low. So you really want to understand what's going on, and there's not any regulation to save you from most of these companies at the end of the day. So you really want to understand what's going on. Same thing with IPOs. I very, very rarely invest in IPOs when a company first goes public, because usually you aren't really sure about it. And this runs true with ICOs as well. Usually, like 9 out of 10 times, the company is going to raise money and then they're going to do kind of poorly after the IPO for a pretty long time, usually a couple of years. Depends on the industry and the company. Like when Coinbase went public, I was shorting them like from day one at like 400, 420. I was like, this is no way, right? And it played out pretty well. Not as well as I'd like, anyway. Most companies, when they first have that initial offering, it's a lot of hype, it's a lot of emotion, there's a lot of things going on that lead initial offerings to have really high prices. And then one of the big ones is you have people that get in at the venture stage when they have really, really early investments, and now they're selling 10% of the company onto the open market. Just in general, most initial offerings do very poorly after they go public for a decent chunk of time. And with a lot of these ICOs, you have that additional risk factor of whether or not it's actually, reputable, whether it's a good project. And usually you can tell in crypto because you just look at the project a year down the road, and if it's trading at $0, then okay, well, good, don't touch that one. But if it's not, then you can start to do some research. So you just want to see that it's the projects have been around, and that gets us into our next stage. And this kind of combines both of the the blockchain, the contracts, whatever the blockchain platform is, with the company side, forming that company, having a profit incentive. And this is really where you have a lot of lawsuits, because these are very clearly securities when you issue tokens around a company. It's like really legal. Some really great examples of this are Ripple and Crypto.com. Crypto.com has over 2,500 employees. They've raised billions of dollars through crypto. They are a really great example of this. And they're a company that's doing big things. They're doing really cool. Anyone here heard of Crypto.com? Yeah.
Yeah, I use it.
You use it. You have the card?
Oh no, I just use it for Ethereum.
The app for Ethereum?
Yeah.
It's interesting. Their exchange product, which is separate from the app and stuff.
Yeah, the CRO coin.
The not CRO coin. They have an exchange, and the U.S. residents can't access it because of the CRO coin though. Were you around originally when they had the MCO token? That was kind of their first token. I put the fund put a decent chunk of change in the MCO token, and not for it. And then what they did is they said, oh, this is a security. We can't have a security. So they said, we're going to stop having the MCO token, and we're going to go over to the CRO token, which has done really, really well. And they said, this is a utility token, which is just BS. I mean, they're all securities. It's very much on the edge of securities fraud, what a lot of these crypto companies are doing, because they don't have SEC filings. They don't have proper disclosures and yada, yada. So that's just a risk factor. You really need to understand if you invest in any crypto project, it also has a company behind it. And the cool thing when you do get to these crypto projects, because you're not going to get in trouble, right? You just have to understand the market value. The security can go down a bunch if there's a lot of lawsuits, yada. But the cool thing with these is you can analyze the company, you can analyze the business model, you can analyze the founders, and you can go into all the nitty-gritty of what the company wants to do and how they're trying to make money. And you can use that to say, okay, cool. Well, now we kind of understand what's going on here. And you can make an investment based on the company's business model. And so that's a cool thing you have with crypto companies. There are some companies that kind of merge the lines between a company and a crypto. Steemit is a really good example. Steemit has kind of their own blockchain that they run, and then or Steam has their own blockchain they run, and there's kind of a foundation. There's a big group of open source developers around the blockchain. And then this company, Steemit, runs sort of this. Anyone heard of Steemit? It's kind of like social media on blockchain.
I had a good one for a little while.
You had a good account?
Yeah, I mean, I had maybe $1,000 of Steam for a while until I said no, it's not going where I wanted to.
Right. Yeah, it's a bunch of Steam, and then it didn't really go where you want. Yeah, they did change a lot of the development.
I think I actually earned most of it just from they had different ways to you could if you posted something and it got a bunch of upvotes, you basically just got free money and stuff like that.
Yeah, you basically got free money on their platform. Because they just generated, they just give the Steemit tokens out, make it up out of thin air, and then put it on an exchange, and it has some kind of market value. That's a really interesting case study, and it kind of merges crypto companies with crypto projects, because they kind of had both aspects of those in one. I traded them a lot at the fund. I did a lot of really active trading with them, and they were just, it's cool. And so, yeah, crypto companies are kind of more so on the company side. And then the big differentiator between crypto companies and crypto projects is that most crypto projects are run by a nonprofit foundation, a nonprofit board. Like Ethereum is a really big crypto project. It's run by the Ethereum Foundation. It's just a charity organization based in Switzerland. With most of these crypto projects, what you're going to see with most of the big crypto projects is they're run by a nonprofit. They're run by not a for-profit company. And that's a really big differentiator, because it differentiates ecosystems and big crypto projects that are designed to be the next Bitcoin, the next payment platform, the next smart contract platform, etc. It differentiates those platforms from kind of more company-based platforms. And at least from personal experience, you're gonna see a higher upside on crypto projects than crypto companies. Because for crypto companies to do extremely well, the underlying company has to do really, really well, and that takes time. You know, it's not gonna happen in 4 years most of the time. The company's gotta take time. And, you know, crypto.com's been around. You know, they're coming on a decade of development, and it takes a long time. With crypto projects, you can publish some new crazy consensus. We'll talk about consensus mechanisms, and we'll talk about that soon next week. But with crypto projects, you can have some really smart new protocols, some really smart new algorithms, some really great new ways to use the blockchain or make your own blockchain. And then people can just see it and buy into it. And crypto projects really have a lot of growth potential because of that. And you'll see them go up extremely quickly when they start to catch on traction because of that. And so that's a really important fundamental difference you'll see. And most crypto projects start out as ICOs, and then they kind of persist for a few years. And usually, with most of the big crypto projects, they're crypto projects because, you know, today we see them as this really valuable. They're like top 100 on CoinMarketCap. They're really valuable. They'll all usually start out as ICOs, and if you've ever seen any of them, they just kind of stay at zero for a long time. It'll go from like 1/100th of a cent to 2/100ths of a cent over the first year or two, maybe 3/100ths of a cent in year 2.5, and then it starts to really pick up traction, and then start to gain a lot of value. And then, you know, just think about like Bitcoin, right? When it first started out, it had no value for years until Bitcoin pizzas, until people started to, you know, think that, hey, we should buy these things. And that's kind of the same track you see for a lot of these crypto projects. They'll start out really, really slow. They'll have this great new technology that nobody knows about. And then when people start learning about it, they gain a ton of traction. They start to go up the ranks on value. And then people say, wow, this is valuable. I should look at it as an investment. And then people come in and do research on it. More and more people learn about it. More and more people read the white papers. They understand what it's about. And that compounds really quickly. You'll see that compound very, very quickly with most of the top projects. If you just look at the top projects on CoinMarketCap or whatever the top cryptos are, you'll see a very quick kind of, at least for most of them, they kind of have that fast growth curve where all of a sudden, you know, nobody knew about it a week ago, and then bam, you know, and this is all relative. This is over the span of months, but it kind of gives you that faster growth potential. You'll see nothing happens for a long time, and then people start to learn about it. They start to do something. They have, you know, Stellar had some big news with IBM and the like, and then it starts to gain a lot of traction. And then, depending on how good your analysis is, kind of depends, you know, like how sustainable is it, and it all just comes down to research at that point. So that's what you see with crypto projects, and they're super solid, and they're not associated with companies. That's the big difference. They're usually nonprofits. They have a lot of open source developers. That's what basically all these crypto projects are. Versus the companies, a lot of it's closed source, and it's just another way of offering securities. It's like kind of legal, yeah. And then the last one is private placements. This is an area of investing that you're probably not gonna touch. Think about like investing in Apple in the 1980s. It's kind of, you know, you've got to be at the right place, you've got to be there at the right time, you have to have a bunch of money to put in, and most of, like, so companies like BitPay, companies like Coinbase, they raised collectively they raised hundreds of millions of dollars. Coinbase raised, before Coinbase went public, it was a private company. They had a Series A. It's just standard venture capital. Everyone kind of familiar with like a Series A, a Series B, a Series C. They raise money. So it's just a private company selling shares in a private placement, which is the legal way to sell shares in a company before it goes public. BitPay, I think, raised $75 million so far, and Coinbase raised a bunch of money. They were in like Y Combinator, right? So they gave 7.5% of their shares, whatever it was at the time, to Y Combinator, stuff like that. Those are just private placements, kind of venture investments, and you really have to, that's just completely different. I don't do much in venture. I don't do much in private placements. Well, I mean, you sell the fund in private placements, but I don't do much with venture. That's venture basically, and that's just a completely different game where you're searching for the newest crypto projects. It's a huge industry. It's one I have very little experience in, and it's just the standard risks of venture companies. Is it going to do really well? Is it not going to do really well? And a lot of times that's hard to tell, but it's basically just completely different from these crypto projects. In an ideal future world, when companies that are crypto companies go public, you know, ideally, you'll have kind of this blend where coin offerings can become equity offerings, and that's kind of what we're pioneering at block transfer, and there's a lot you can go into with that. The whole idea of everything being decentralized, everything on the blockchain. There's a lot of really cool ways to, and there's some cool platforms too that do private placements on blockchain. And the nuances behind that are you have to be an accredited investor, so you have to have a couple $1,000,000 in the bank, you have to make a couple $100,000 a year. There are just some doors for private placements and VC that are prohibitive for a lot of investors. And so in terms of where these projects fall at the end of the day, most of these ICOs kind of in this venture space, most of these crypto companies are also in this venture space, namely the ones that aren't public, which is about like 99.9% of them. There's like one public company. There's like blockchain companies, so I guess it depends on your definition of crypto company. But most of these are going to be in kind of this venture capital stock kind of volatility. And that's why you want to put in the venture capital stock kind of research. I don't have much experience in venture capital. A lot of it's based on, I don't have much experience in research for venture capital. But for individual companies, you really look through their financials, you look through their business plans, you look through their models, and you just understand what they're doing. So that's kind of where they fall in on this scale. And then everything else is kind of in that same kind of volatility. The projects, you really just research and research and research. And I think I've said it about 100 times so far, so forgive me. But most of the understanding we do here, aside from technical analysis, for timing everything, comes down to just researching the investments. And everything here basically falls into research. And most of the crypto companies will fall under the general kind of ETF space, if you can call it that, of Bitcoin and kind of the whole, top market players. And that'll determine basically most of the directions they move in. So yeah, that's kind of the basis of crypto correlation, and then how to look at the different projects and investments, the opportunities that are in the space. Yes. Cool.
Why is it that
Yeah.